We'll get everybody lined up. I know everybody's probably coming in. They're all, maybe they're out doing their early voting, maybe, right?
Or maybe
Yep.
they're still in Miami.
What a week we had last
What a
week, right?
week.
I mean, man
Man.
alive, for those of us that were in Miami, I'm going to tell you right now, amazing.
Don't
I
miss it
don't
next
know.
year.
I don't know about you guys, but everybody that was there with me knows what my favorite thing was. And I'm telling you, right, Jesse Etzler was by far one of the best speakers, I think. Every emotion, everything, absolutely awesome and amazing. I can't wait to see and experience him again. But what a great, I mean, it was just awesome. What a phenomenal event. One of the best EXP cons I've ever been to in all of everything. So anyway, we are back. And what is tomorrow, guys? Tomorrow is get out and vote. Oh my gosh. My husband, who's been glued to football, I'm the opposite. So politics is mine. That is my Super Bowl. I love politics. I have a degree in political science. I absolutely am addicted to watching what is happening and what is going on. No, we're not going to turn this into politics, but today we are going to talk about the economy. We're going to talk about what it is that we need to know about the economy. How can we be empowered to help our clients? What is it? I mean, we've got such an amazing guest on here today, Bruno Valko, who is actually out of Canada, you guys. But let me tell you something. I'm blown away by his knowledge. I'm so grateful that he is spending this time with us to empower us to know more and to understand. Because look, regardless of what happens tomorrow, regardless of who our president is, we need to understand what is happening with our interest rates, what is happening with this economy, and how are we going to plan for our 2025? Because this is your business planning season, and that's what you're going to get out of this today. So, Bruno, welcome to Grow Global's Realtor Mastermind. We're going to have agents come on this the entire time. Why? Because realtors run late, unless you're like me, and you're always early. Welcome, Bruno.
Thank you. Do you want me to start sharing my presentation?
Absolutely. Give us some background of you, Bruno, if you don't mind.
Okay, let me just get the presentation up.
Yeah.
Okay, so a little bit of background. I've been in the mortgage business in Canada for a very long time. You're probably wondering why a Canadian is presenting today. The reason a Canadian is presenting today is because the American market obviously has a lot of influence on Canada. I've been following the 10-year Treasury, implications to the 10-year Treasury yield for quite some time, because that 10-year Treasury yield in the US, which is, of course, where you price your mortgages from in the US, influences our 5-year Government of Canada bond yield exactly. And whatever impacts the American Treasury impacts the Canadian mortgage industry, which of course I am heavily involved in. So I'm the vice president of national sales for a company called RMG Mortgages, which is a division of MCAP. I mean, the Canadian mortgage market is different than the US market, but when I talk about the economy and implications to the economy, obviously the American economy being immensely bigger than the Canadian economy has an impact on us. And they say, you know, the saying up here in Canada is when the US sneezes, we catch pneumonia, simply because of those implications. So do you want me to start the presentation? I can go through it, and
I love
hopefully
it.
everybody
Yes,
will get
Bruno. No, I
perfect.
think this
So
is amazing. I mean, this is something that's so important for all of us to understand, inflation. I mean, look, the election tomorrow, I think that's number one in our entire, issue as far as what we're voting on is the inflation and what's going on in the US. So I love this. I can't wait to hear.
So maybe it's good to get a third-party Canadian presenting today, since I
I
have
love it.
no no political aspirations in the
Yeah.
United States. So I'm completely neutral here. So we're going to talk about a few things. So 2019 and 2019, I reference a lot because I think that there is an opportunity for both countries, the Canadian and the American economy, to get back to where we were in 2019. The 10-year Treasury yield, of course, influence on the job market. I'm going to talk about inflation, the US labor market, which we know the numbers that come out on the labor market from the Bureau of Labor Statistics have a large influence on direction of treasury yields and so on. They talk about resilience, but I'm going to talk a little bit about weakness. And keeping in mind, when I talk about the weakness, bad news is good news for bond yields. I mean, good news is bad news for bond yields. So when we get bad news, we get lower mortgage rates potentially as those yields come down based on that news. Credit card debt and spending, that's a bit of an issue. US deficit spending implications to the 10-year treasury yield. And I'm going to talk about bond vigilantes, which, they reared their ugly heads a while ago. They're coming back now. And they were back on Friday, just last week. And then, of course, the Fed meets on November the 7th. Of course, you have your election tomorrow, and there's going to be a lot of volatility in the marketplace. So again, I'm from Canada. I wasn't sure if there was going to be Canadian realtors or not. I'm told there might be a few, mostly Americans. But again, the American economy influences the Canadian economy way more than what happens here in Canada. So when I go back to 2019, I say, well, where were we in 2019? And are we on our way back? And certainly we hope that we are on our way back to these interest rates. I mean, the Fed was at 1.75. The Fed, after their half point cut, is currently at 5. I mean, Canada's at 1.7, was at 1.75. We're down to 3.75 as we lower our rate up here. Unemployment rate in the United States, it's higher than it was in 2019, even though it's still at a very low number of 4.1. It's still higher than the 3.6 you had when the Fed was at 1.75. Inflation rate in the United States is at 2.3. That's the headline number. We talk about core, we talk about different inflationary pressures. But the bottom line is the inflation rate was 2.3% in 2019. It's at 2.4 now. In Canada, we're at 1.6, extremely low. So the inflation rate is about the same as where it was when your Fed was at 1.75. The 10-year treasury yield was at 1.87 back in 2019. It's currently sitting at 4.285. I did this at 10:51 a.m. today. So much higher than where it was back in 2019. Of course, we want to get back to 2019. One of the main barriers to getting back to 2019 is the massive amount of government deficit spending. So the deficit in the United States, 1.8 trillion. In 2019, it was essentially half that. In Canada, we're at 51 billion and we were at 12 billion in 2019. So we're like 4 times where we were back in 2019. So why do I know all this stuff about the 10-year treasury? This is just a quick glance at the 10-year treasury yield, which is the green line. The blue line is the 5-year government of Canada bond. And this goes back to 2000. So we're going back 24 years. You can clearly see the 10-year treasury yield dictates the direction of where the 5-year bond yield is going to go. So that's why I follow it very closely. And that's why I'm going to talk a lot about the 10-year treasury, which of course impacts your mortgage interest rates in the United States. So back September the 16th, things were pretty good. The 10-year treasury yield was 3.6, which was very good. Canada, we had 2.68 on the 5-year bond. You can see the direction of the line, but what happened, right? The Fed lowered interest rates on September the 18th by 50 basis points. And I think most of us thought, okay, mortgage interest rates are going to come down on the 30-year mortgage. Instead, they went up. And then you say, well, why did they go up? There's a few data points that came out. The ISM Services Index came out and it exceeded expectations, led some to believe that it was inflationary. Anything inflationary is going to cause the 10-year treasury yield to rise. And then the US non-farm payroll numbers came out, not the recent ones, but the ones that show 254,000 jobs on, I think, a 140,000 market consensus, blowing past expectations, leading to potential inflationary pressures. When that came out, the yield went up further. And then the US retail sales numbers came out and they exceeded expectations. So when I talk about bad news is good news for bond yields and treasury yields. Good news is bad news for treasury yields. It drives them up. So we're sitting now, call it 4.28 in and around that area, simply because even after the Fed lowered rates by 50, all this news came out putting upward pressure on yields. So this is some of the data that came out just quickly. You can see the 10-year treasury yield when that ISM services number, just so you know, the ISM services number, sorry, for those that don't know, the ISM services report measures the economic activity of more than 15 industries, measuring prices, inventory levels, and employment. Anything greater than 50 is expansionary. Anything less than 50 is contractionary. The ISM services number has been higher than 50 for quite some time. The manufacturing ISM has actually been negative. I think those of you that live in industrial manufacturing segments understand that the manufacturing sector in the United States has not been doing well and has been losing jobs and has been in contraction. It's the services side that has been an expansion, and services being, of course, travel, all those different things, going out, going to concerts and going to different things. People are spending money on experience, not necessarily on product. So when that ISM services number came out, the US 10-year went up 6, Canada's went up 8. On Friday, you got your non-farm payroll numbers. That 254 was, of course, revised down. We'll talk about revisions later. Previous was 159. Consensus was 140. Boom. The US 10-year treasury went up 13 bips. And then the retail sales numbers came out way greater than consensus, was 0.3, 4 times what the previous number was. You were at 0.4, went up another 7 bips. So this is what was causing that increase in the 10-year treasury, and of course putting upward pressure on your mortgage interest rates. So what I did is I went and I looked at the MBA mortgage market index, and I said, well, where were we in 2019? So in 2019, your points were at 568.4 points for the mortgage market index. Back on September the 20th, you were at, call it 296, which is still way lower than 2019. The Fed drops rates by 50 basis points, and then you can follow the line downwards. And the gray line is, of course, your 10-year treasury yields. So the 10-year treasury yield started to spike based on that news that I went through. As the gray line goes up, the 10-year treasury, your MBA mortgage market index plummets, right, downwards. So the challenge is, how can we get back to this number back in 2019? The more mortgage activity there is, of course, housing market picks up. We need lower interest rates. I read something just online in terms of the market in the United States and how do we get back to affordable housing? I mean, do the housing prices have to come down? Do interest rates have to come down? Do incomes have to go up, or any combination of those three? But currently, the affordability of purchasing a home, both in the United States and Canada, is very stressed. And getting back to that 2019 level for both countries would be very beneficial. I mean, the 10-year increased by 13.5% in value, and the MBA mortgage market index decreased by 27% in value since the Fed cut rates by 50. I think the ultimate goal for the Fed was, if they cut rates by 50, they'd get a better interest rate and they'd get more activity in terms of mortgages and purchases and so on. They want to kickstart the economy by lowering interest rates, and instead the opposite happened. And then we'll talk a little bit more about why on some of those data points, but there's other data points too. And then there's those bond vigilantes that I'll talk about in a little bit. This graph is good. It's a little bit difficult to read, but I've been using it here in Canada because I try to explain what is the difference between a mortgage in the United States versus one here. I mean, 30-year mortgages, fully open. Of course, that's your main mortgage. But if you look here and you can see the vintage years of 2020, 2021, early 2022, before the Fed started increasing rates, rates were extremely low. I mean, you look on the left-hand side, you can see the green, the dark green, mid green, light green numbers. That's the amount of people, almost 5 million mortgages at, call it 2.875, right? So you're getting mortgages in at 3%, 3.5%, less than 2.5% when those mortgages were extremely low. The good news is the cost of living is significantly discounted because as the Fed increases rates, your mortgage rate doesn't change and you got 27 years to go at 2.5%. You're pretty happy. The bad news is you can't afford to sell because if you sell and you buy another house, you lose your mortgage rate. And that's a problem if you're going from 2.5% to 6.5%, right? So this is part of the reason why I guess the mortgage market is pretty stagnant. I mean, here in Canada, our mortgages renew every 5 years. So we're very heavily impacted by rises in interest rates because as mortgages come due, you get the brand new interest rate. You're not sitting in your mortgage for 30 years at 2.5%. I'm sure a lot of people here would be very happy, including me. My mortgage is due next year. I would much rather have 27 years to go with the rate that I have.
Hey, Bruno, with that news, it sounds like to me we could pick up a ton of business if we just convince all you Canadians to just come into the US.
Well, they were coming to the US. I think a lot of Canadians bought in Florida. But now, with interest rates on the rise here in Canada, many people took out mortgages in Canada to buy recreational properties and vacation properties in Florida.
Hmm.
Now with their mortgages coming due, it's a bit of a problem. So,
Uh-oh.
we have definitely come down to the US to buy those properties, but it's now reversed itself. I think a lot of those homes for sale in Florida right now might very well be Canadians trying to sell because their mortgages are coming due and their mortgage payments here in Canada are going to go up six, seven, $800, and they can't afford to keep the property in Florida. I think a lot of those properties for sale in Florida are, and I don't know if we have realtors on here from
Mm.
Florida,
Oh,
but you
yeah.
should be going after the Canadians. I think they're selling a lot of their
I
vacation
identify
properties.
the Canadians. I know I saw a handful of Florida agents on here. I know I saw Jennifer. Jennifer, did you hear
They're
that? Kim?
they're quite those mortgages coming due in Canada. If you did refinance your home during the pandemic and you got some crazy low interest rate, you might have taken equity out of your house to buy a place in Florida.
All
Well,
right,
And
good.
we're
now
on
that
it down
mortgage is
here in
coming due
Florida.
5 years
Yeah.
later, and you might be in a panic.
Lots of
So there might
Canadians
be some
coming to
Canadians
Georgia
selling.
now too. By the way, Bruno, a lot of Canadians from the West Coast to like Vancouver to Toronto, they all come to Atlanta, Georgia right now because I have like a list of clients that looking to invest and buy in Georgia. That's the next best
Oh, they want
hot
to
market.
buy. Okay.
Oh,
In Georgia, Canadians. Wow. Well,
Canadian.
good.
Yeah.
Good for
They
them.
researched it. They say that, Florida kind of maxed out for their, cap rate. So right now, Georgia is the best. They brought me all the research. They told me why they should buy. I'm like studying, right? And they already told me that that I should buy in Atlanta, Georgia.
Okay.
Huh. Very
Good
cool.
news. Good news. So the inflation rate in the United States, I'm sure you know this, has been stable. As I mentioned, you're at 2.4%. Consensus was 2.3. 2.3 matches where you were in 2019. A little bit higher, which of course, anytime this inflation number comes in higher, it does put upward pressure on your 10-year treasury and upward pressure on your mortgage interest rate. So coming in and around, it was a little bit lower than the previous reading. The next reading is November 13th, so certainly cheer for numbers less than the market consensus so that those yields can continue, well, or start to go down um, based on the inflation number. So, inflation, jobs, retail sales, these are all the things that impact your 10-year treasury yields, of course, impacting us here in Canada. See here, February 2020, it was 2.3. Go across, you had this massive increase in inflation. Obviously, it was supposed to be transitory. It was not transitory, and the Fed started increasing interest rates. Both here in Canada and in the United States, it absolutely drives me crazy when the government takes credit for inflation coming down. The only reason inflation is coming down is because the central banks jacked rates from 1.75 to 5.5, from 1.75 to 5 here in Canada. So when we got those massive increases in the central bank rates punishing consumers, so not only do you have this high inflation rate, now you have a high cost of borrowing on top of your high interest rates. It's a double whammy. And the only reason inflation is coming down is because the central banks increased interest rates. The governments, both in Canada and the United States, have fueled inflation with deficit spending, right? And we mentioned that in terms of where it was in 2019. But when you flood the economy with massive amounts of money, 10 times more probably in the United States than in Canada, you're going to fuel inflation. You're not doing anything to subdue inflation by increasing your money supply, increasing your inflation, and so on. So when we look at the job numbers, I'm going to talk a little bit about revisions, and hopefully for those of you that like data, I'm a bit of a data junkie. I like data. But the revisions in the United States are driving me crazy because whenever the headline number comes out, be it that 254,000 headline number that came out for September, we immediately get an increase in bond yields here and in treasury yields in the US. So they spiked that day because that number came out and the number was way past where the market expected. Recently, the number came out at 12,000, but what they did is they revised everything. So I'm going back here to September because I want to show the revisions. So there's the headline number, there's the revised number. You can include the October headline number was 12,000, so it's insignificant. But it's the revisions that are a problem. So in the United States, you've had 405,000 negative revisions to the headline number. The headline number comes out, the federal government does victory laps, look how great the job market is, but they don't talk about the revisions on the back end. And it seems like the revisions fly under the radar with the focus on the headline number. But when revisions are as high as they are, it's not normal. So when I ask here, is that normal? It's not normal. Back in 2008 and 2019, look at your revisions. Your revisions were 101,000, which is not a lot. I mean, you get 101. Actually, the last number was revised 81,000 for August and 23,000 for September. So you actually had more revisions in the last print, in one print out of 12, than you had in the entire year of 2019. You had 101,000 revisions in the United States relative to whatever it was, call it 100, 103,000. Oh, a little bit more in the last print. So these revisions are crazy, and it isn't normal. 2018, there was 148,000 revisions in job numbers on the upside. Again, when you get these job numbers, it really does negatively impact your mortgage interest rates because that 254,000 caused bond yields and treasury yields to skyrocket, putting upward pressure on your mortgage interest rates. And then they go ahead and revise by 103,000, the latest print on Friday. So 2023, you had negative 360,000. There were 405,000 negative year to date so far. And that's 19% of the headline number, where you were 4.9% on the upside in 2019. So far more revisions going on these days than there were before the pandemic, call it, back in 2018 and 2019.
Bruno, I have a dumb question, and because I don't, why is that? Why would that be? I'm just curious. I mean, is there a reason for that?
There's
You're a
speculation.
third party. I just would love to understand it better.
So the data is readily available. This presentation, by the way, is readily available. Please talk to Tracy. Tracy has the presentation. She can distribute it to whoever wants it. You can click on the BLS number here. So this isn't any kind of conspiracy theory here. Don't think that. I'm getting this data right off of the Bureau of Labor Statistics website. And even Jerome Powell, the chairman of the Fed, is saying that these numbers are heavily inflated. It's almost like he's mentioned that 2 times. When he lowered rates 50 bips, one of his first sentences in his announcement was he feels that the Bureau of Labor Statistics is inflating numbers. These numbers are critically important to future interest rates, be it the 10-year Treasury yield or be it whether or not the Fed's going to decrease rates. So they're very important data. Why is it? Well, I mean, some people would speculate that maybe there's some political influence here that, in 2018, 2019, you had a different president, and yet the headline numbers were understated and then revised upward. Now you have a different political party, and the headline numbers are heavily inflated and then revised to the downside. So I don't like to speculate, but some people would say there is some political pressure, or I don't know, political pressure, maybe internally, maybe some politics involved in these numbers. But I'd like to think that that's not the case. that um, that they're revising these numbers based on seasonalities, and you've had some hurricanes that have impacted some numbers potentially, but um, anyway, it's I'm also hearing that the Bureau of Labor Statistics is looking to revamp the way they calculate these. And just so you know, in Canada, we have Stats Canada that does our numbers, our job numbers. Our job numbers are coming out on Friday. Very rarely, if ever, are there any revisions. And I asked an economist, well, why does Stats Canada not have revisions? In the United States, it's it's unbelievable how many revisions they had. And this is on top of remember the 818,000 that they just dumped in August and said there's 818,000 negative jobs. There was 1,000 more government jobs, but 818,000 negative jobs that in one dump of revisions of negative numbers. And on top of these, and they said that, well, there's a difference in calculation. So in the United States, they're using the establishment survey. In Canada, they use the household survey. They lean more towards that. The household survey can be deemed more accurate, and then the establishment survey, because my understanding of the establishment survey is if I quit my job halfway through the month and get another job, I count as two jobs. Well, how is that? I quit my other job, got another one, but I'm counting as two jobs. So, I mean, why the revisions to this extent? I don't know if politics are at play. I'd like to think that that's not the case, but some people would speculate that that is part of the challenge. Is they're inflating the headline number, and even Jerome Powell is saying they're inflating the headline number, and that's not good when the chairman of the Fed is questioning job numbers. I don't think that's
Yeah.
healthy. I
Well,
mean,
and
you
if the
want the
truth,
chairman of the Fed, they're determining interest rates. The data that he gets should be accurate.
well, and if the truth gets us lower interest rates, that's
Yes.
what is in our best interest as this industry. So that's why I wanted to ask the question, because I knew that to be the case, but I wanted to verify and make sure that I wasn't misunderstanding. So I appreciate that confirmation, Bruno.
I don't have the answer to it, but you are 100% correct. If the truth gets us lower interest rates, isn't that important? I
100%.
mean, and here in Canada too, because remember, our mortgage interest rates are influenced by these job numbers that come from the Bureau of Labor Statistics. So you definitely want accurate data
Which,
that
which is
allows the yields to be accurate and not inflated, as Jerome Powell is saying. He's
exactly.
telling us they're inflated. 2 times he said that.
Mm. Phew. Okay.
So issues with the US labor market. So bad news typically is good news for bond yields. And I think that the market will eventually start to look at these numbers and start to realize what is the true state of the American economy and the job market. I mean, the people on this call obviously know more about the job market in their regional areas. Is it healthy? Is it strong? I mean, we hear a lot about record setting multiple job holders, um, record setting, record number of multiple job holders, record number of part time jobs, and so on. So, what I did is I kind of dug down a little bit deeper. As I mentioned, the ISM services index, which is the gray bar, has been very strong. Anything greater than 50 is expansion, anything less than 50 is contraction. And the manufacturing sector has been contracting very strongly. I mean, you can see the blue only one time in the past year has that blue been above 50, which is the manufacturing sector. So you've got a contractionary manufacturing sector. We know manufacturing jobs are private sector jobs. Manufacturing jobs are typically well-paying union jobs. In many cases, many communities rely on the manufacturing sector. The services sector is heavily reliant on government sector jobs, which are, of course, not private sector jobs. Private sector jobs obviously pay taxes to supplement the government jobs. My dad worked for the government, and I mean, I'm fine with that, but he even understood you need private sector jobs to pay the taxes to support the government sector jobs, the public sector jobs. But when you got a contraction in manufacturing, which are good paying jobs, and you've got expansion in the services sector, which are either low paying in many cases, restaurant workers, part-time work, and so on, or government jobs, it's an issue for future strength of the labor market. And that's why I'm sharing this slide. One of the key things that they don't talk a lot about, which I'm pretty amazed, is the shrinkage of full-time jobs. I mean, the United States has lost 1.2 million full-time jobs. I mean, since July 2023. People would argue, well, 2 years ago, if you look at 2 years ago, we've gained. Yes, but look at the last 12 months. I mean, you're losing a lot. You're bleeding out full-time jobs. And I don't even have the October number yet, but I'm assuming with the poor job print, the 12,000, and the loss of manufacturing jobs, that number is going to be, again, more full-time jobs lost.
Bruno, is there anything specifically that's creating that job loss? Is it that people are going more towards, freelance type of work, or are the opportunities just disappearing?
Well, there's a lot of people moving out of the labor market to some extent. There's the loss of the contraction of your manufacturing sector in the United States, which is a loss of full-time jobs. People are losing their full-time jobs and they're taking 2 part-time jobs or 3 part-time jobs. I mean, maybe they could be freelancing, but even if you go into that, you might be full-time in your own business. I don't know. But the manufacturing sector and the contraction of it is definitely causing a loss of full-time jobs, right? And they're being replaced by government jobs in some areas, but even the government can't hire enough people to replace the loss of full-time jobs. But this is a problem, right? I mean, you got to reverse this. And I always say, well, how do we reverse it? Because in Canada, we have a similar problem. So how do you reverse it? Well, we talked about it earlier. We need to get real, well, I know, truthful, real data that the chairman of the Fed can rely on, that he trusts, that isn't inflated. I'll reference him, so that we can get numbers that bring down interest rates, because elevated interest rates and elevated inflation, massive government spending isn't really helping our real estate markets. I mean, what's going to help our real estate markets? Lower interest rates. If we get lower interest rates in both countries and we can kickstart the real estate market, well, if you kickstart the real estate market, what does that do, right? In both Canada and the United States, well, that helps private sector jobs. Realtors make more money. Mortgage companies make more money. Construction picks up because construction's an issue. We're not building enough homes. You're probably building more homes in the United States than we are here in Canada. In Canada, we struggle with building homes. We just don't have a supply of homes, which drives up the price and makes it even more unaffordable. So construction is private sector. All the stuff that comes with lower interest rates going back to 2019 is private sector jobs. So if you lowered interest rates, cut your spending a little bit, maybe you sacrifice some public sector jobs, but if you're boosting your private sector, isn't that going to help all our economies, all our regional economies everywhere when we get this private sector back on track to where it was in 2019? So, and of course, manufacturing jobs are key to that. I mean, manufacturing people make good money. They're unionized, and we need an expansion of the manufacturing sector. And we can't say, well, we're not a manufacturing country. Well, that's not good, because those are good paying jobs, right?
Right.
So we got United States jobs in August of 2024 versus November of 2023. You can see the number of full-time jobs, and then, as I mentioned, the number of part-time jobs. So in this graph here, you can see part-time job expanding from 27 to 28 million, but full-time jobs contracting the other way. Which, of course, when you think of this bad news, again, we should be looking at lower 10-year Treasury yields in preparation for this, because I can't imagine the Fed isn't looking at this on November the 7th thinking, do we need to bring rates down to help the manufacturing sector to get more people on track? But of concern is, of course, government spending. So when we look at, well, what's going on with job openings? Well, look at the job openings from September 2022, right? So they've gone way down. So the number of openings aren't there. And if the number of openings aren't there, well, the number of quits aren't there. So people aren't quitting their jobs because they can't really find jobs. The jobs aren't as readily available as they were before. So you've got people hanging on to the jobs that they have, not quitting, which again is good news for inflation, because when you quit a job for more money, that's inflationary because you're making more money. But if people are hanging on to their jobs, that's good news for bond yields. It's bad news for the labor market. But again, bad news in the labor market should equate to good news on the mortgage interest rate side. So US continuing jobless claims in 2019, there was 1.68 million on average in the continuous jobless claims. So these are people that are on unemployment insurance. There was 1.67 million on November the 9th. So, 5 years ago, basically, essentially from today, close enough. Now there are 1.9 million people, which is the highest number in 3 years. So people on unemployment insurance on October the 24th were at their highest level in 3 years' time. And often when you do get this presentation, if you want it, I do have links here to where I'm getting this data from. But on November the 7th, you would like to think that the Fed is going to look at these numbers and say, holy smokes, I mean, we got a lot of people that are on unemployment insurance, even though our unemployment rate is 4.1. I mean, is there an opportunity here to get people back to work and get back to that 2019? Again, 2019, the Fed was at 1.75. Fed's sitting at 5% right now, and you've got way more people on unemployment insurance. So consumer credit may impact retail sales. Something that I've been kind of watching for quite some time, because 68% of the US economy is the consumer. 60% of the Canadian economy is the consumer. So consumer spending, be it retail sales, is critically important to the GDP number. So if 68% of the GDP in the United States is the consumer, well, retail sales is going to be a big part of that. One of the things that is a red flag, and there's a few red flags here, is credit card spending. One second. So credit card balances in the United States have gone from 787 billion in Q2 2021 to 1.14 trillion in Q2 2024. One of the things to watch out for is this flattening. So as this is skyrocketing, it might look bad because, oh, holy smokes, look at all these people putting money on their credit cards, but they're spending. So the retail sector is doing quite well. Services are doing well. People are buying vacations. They're putting stuff on their credit cards. Things are going pretty good as that credit card balance skyrockets. It dipped a little in Q1, and then it kind of rose a bit here in Q2 2024. But it's a red flag because it's kind of flattening out. So if this retail sales number, if people are putting less money on their credit cards, if the credit card balances aren't growing as fast, and we'll talk about savings, oh, they're spending their savings, we'll talk about that in a little bit, that's a bit of an issue for retail sales. The other thing that's a huge issue for retail sales is arrears rates. So this comes from the New York Fed. The arrears rate in Q2 2023 was 5%. The arrears rate in Q2 2024 is 7.2. So you got a skyrocketing of people in 90 days or greater delinquency. So 90 plus delinquency, I mean, that's a lot. These aren't people that are just missing one payment, making it up. This is 3 months. I mean, a lot of people don't come back from 3 months in arrears. The other red flag is you were 5.32% in Q4 of 2019. So again, rates were far lower. People were paying less interest on their credit cards. The delinquency rate was 5.3%, which kind of matched where you were a year ago. But now 7.2 is way higher. And we're going to get Q3 data shortly. It's going to come from the New York Fed. It usually comes out in the second week of this month. So it should come out second week for Q3 of, it's called 6 weeks after the quarter end. So it'll be interesting to see where the new data comes. But certainly the trend of higher interest rates, I think the highest interest rates on record right now on credit cards, very high delinquency rate, and a flattening of spending is a bit of a problem. Which, of course, is another inspiration to bring rates down. So is the Fed looking at that saying, hey, if we lowered rates, are we going to have an issue on the retail sales side? That's why when the retail sales did come out very positive, it brought bond yields up a little bit. But is that trend going to continue if people don't have room on their credit cards? Credit card debt versus savings rate. You can see here the savings rate right now in the United States is at 4.8%. That number was, by the way, revised lately. It was like 2.9, and they went and revised all the savings rates for whatever reason. The average from 1959 is 8.4%. So even though it's 4.8%, it's far less than the going average since 1959. So savings rates are very, very low, and you can see credit card rates skyrocketing. So it's not like there's excess savings anymore. Those savings are done. You can see here during the pandemic, people had nothing to do. Of course, you're in lockdown, you're not going out, you're not spending. Savings rate was over 30%, which was great. And then everybody spent their money, flooded the economy with spending, which of course caused our interest rates to rise. And of course, the Fed had to increase rates to cool inflation. But now the savings rate is way lower than it was before the pandemic. So if you reference 2019, you're way lower than you were in 2019. So not a lot of savings, not very much excess savings. Credit card debts are getting tapped out. There's going to be an issue with spending unless interest rates come down to help spur it on. I looked at this and I saw, well, Discover Financial, they posted this. Well, delinquency. Sorry, this isn't delinquency. This is actual charge-offs. So charge-offs on credit cards for Discover Financial are at almost where they were during the bad times of the Great Recession, of course, the financial crisis back in 2011, 2010. The peak was 9. They're at 5.7 now, just under 6, call it in 2011. One of the things I read was Ally Financial, a significant player in the auto industry, has echoed similar concerns. The bank reported elevated charge-offs and has tightened lending standards to mitigate potential future losses. A couple of things here. When you're tightening your lending standards, that impacts retail sales because people can't buy, they can't qualify. And of course, the elevated charge-offs. So this action is expected to further depress the already troubled auto industry. Notably, other major banks, Citigroup, JP Morgan, so on top of Discover Financial, have also reported rising credit card charge-offs, signaling widespread financial strain. So there's red flags here that, of course, the Fed is going to look at on November the 7th, and they've kind of priced in a 0.25% drop. But who knows? I mean, last time everyone was thinking a quarter and they went a half. I don't know, obviously, how much. I'm not going to make predictions, but there is certainly a lot of bad news out there. One of the things that I've noticed is this shift because credit cards and charge-offs are a problem. Consumers are shifting to this buy now, pay later program. Buy now, pay later is a lot of red flags from a financial guy only. I'm speaking here. Tons of red flags. The number one red flag I see with buy now, pay later programs is what people are buying. So you can go to Walmart and buy groceries and buy now, pay later. I mean, if you're buying your groceries because you can't afford to pay them now and you're going to push forward paying them, that's an issue. Number two is these aren't financial companies. These are tech companies coming out of California that are devising programs to make it easy for people to buy stuff now and, of course, pay down the road. The other thing is they don't report to the credit bureau. Wall Street doesn't know that how much there are out there. I mean, we're all guessing how much. They show the grid there in terms of growth, but Wall Street doesn't know the exact balance of all these things because they don't report to the credit bureau. I think it was Wells Fargo. It actually was Wells Fargo did a study, and you can Google this. They call this phantom debt in the sense that Wall Street doesn't know how much there is. We don't really track it very well. It's not financial people doing this. I mean, the interest rate, if you miss your payment, is 36%. There's tons of fees on this. And it seems like it might be geared towards a lot of people that are desperate. Buying groceries, buy now, pay later. Buying, clothing and different necessities because you can't afford to pay it now and you're going to kick the can down the road and pay it in 4 installments is pretty bad. So, and it is inflationary too because the retailers will pay 2 to 8% fees for this program. So people will pay higher prices to access these programs. So they essentially can't afford to pay for it now, and they feel as though they can pay for it later. So just a red flag on these buy now, pay later programs. So potential bad news for 10-year yields is your government debt. So I'm going to go quickly through these slides. I did a presentation here and I said, well, the US economy is doing better than most economies. The GDP growth is better than Canada, certainly better than Europe, and it's better than China. We're struggling compared to the United States. We're struggling. Our GDP is growing nowhere as fast as the United States, nor is Europe. We hear about Germany, we hear about China. In China, they're almost in disinflation. I mean, the products coming from China right now, the United States and Canada, are actually coming in cheaper. There's like a disinflationary pressure on those products. But of concern here, of course, is the debt that's paying for this. And you can see here on the right-hand side, I've got the US debt, and then I've got the money supply. So the M2 money supply in the United States is rising for whatever reason. I mean, it could be pre-election. Let's flood the economy with money and make everything look like it's great. But that's also going to put upward pressure on inflation, not to mention the government debt, which is growing at the same trajectory. In 2015, something weird happened. And what happened was a divergence of the US deficit and the unemployment rate. If you look previous, I'm going back to 1970 here. As went the US budget deficit, so went the unemployment rate, or vice versa. So as the unemployment rate rose, the government spent more money. And when the unemployment rate was low, the government might have saved some money or spent less money because, hey, the economy is doing well. We have a low unemployment rate. We don't have to flood the economy with money because we're doing good. Let's save the money for bad times. So when unemployment's high, let's spend money, makes sense. When unemployment is low, let's save money for those bad times. Well, that all changed in 2015 for whatever reason. There's a divergence. So the red line is the deficit. So that's the US budget deficit is the red. You can see here unemployment from the financial crisis peak just slid all the way down to 2020. Pre-pandemic, you see this negative unemployment rate down to 3.6% in 2019 from a peak way up here of close to 10%. But for whatever reason, 2015, as the unemployment rate dropped in the United States, the deficit was increasing. Like, why is that happening? That never happened before. Before, they would follow the same trajectory. And then, of course, take away this pandemic, but then you look here, you still got this massive increase in deficit spending while your unemployment rate is down here. Now the unemployment rate has been ticking up a little bit, but it's still very low. 4.1% is a very low unemployment rate, but the deficit spending is astronomical. $350 billion deficit in August 2024 alone. So it's like massive debt, and it's getting worse. So I'm just trying to point out here, you know what? The deficit continues to rise even though unemployment is low. When is all that going to iron itself out? Like, how sustainable is it? The United States grows their debt by $2.48 for every $1 of GDP growth. The difference between that is kind of profligate spending. I mean, it's not resulting in GDP growth. What is it doing? So yes, governments have to spend, build ports, build pipelines, dare I say, build different things that will help your GDP, highways. But all that spending should result in GDP growth, but it's not. A lot of the spending is wasteful. And a lot of people would argue that the difference between the GDP growth and the debt is wasteful spending. Two things here. I just saw these posts on LinkedIn and I said, you know what, I'm going to share these. I thought they were very good. What is the cost of all of this debt? Right now, over $1 trillion is what the United States pays in interest on their debt, which is astronomical. What else could you do for $1 trillion? I mean, you could do a ton of stuff with $1 trillion, right? But it's going towards interest payments on debt. When you look at public debt net interest payment to GDP, the United States is far higher than even countries like Greece, Spain, Portugal, the UK, which we hear a lot of bad news about. The United States is much higher. And then when you look over here, Spencer, Hakiminian, I'm sorry, I'm not sure how to pronounce his name. You're going to be waiting for a very long time for a recession if you don't understand how our economy works. When government spends like this, you should worry about currency debasement, stubborn inflation, and avoiding bonds. Avoiding bonds means, of course, 10-year treasuries. So this massive government spending, here's a guy saying, you know what? You might not want to buy bonds because not a good investment with this crazy spending that's going on. Because if there is stubborn inflation, yields are going to continue to rise and prices are going to drop on those 10-year treasury yields and others too, and so on. And currency debasement, of course, is another problem, right? When governments spend like this. Over $1 trillion. I mean, you can see here from 2021, sorry, and on. This is from Bloomberg, just shows the interest costs of the 35 trillion in debt. Quickly, I'm going to go through what bond vigilantes are. The bond vigilantes are fighting to be heard and starting to be noticed. This comes from Friday. So, as their name implies, bond vigilantes are on the lookout for trouble. They worry that loose monetary policies and soaring fiscal deficits will push up bond yields and depress prices since they move inversely. Three things, of course: there's fiscal slippage, huge debt supply coming down the pike, and sticky inflation resulting from higher spending is dominating bond market sentiment right now. And this is why on Friday, the 10-year treasury went up 10 basis points, even though the job release was very weak. And a lot of people started referencing bond vigilantes. Bond vigilantes is essentially just the market. The market is saying this quantity of bond issuance does not meet the demand, or sorry, far exceeds the demand. And what happens is, because these debts are so high, the market is saying, you know what, we'll buy it, but we'll buy it at a lower price. And if they buy it at a lower price, the yields go up. Or even worse, they sell and they flood the market with more, which of course decreases prices further and jacks up yields. And that's a problem for future mortgage interest rates. It's just a matter of bringing the spending in line. And it might not be a revenue problem, it might just be a spending problem for all Western countries. When you increase your GDP by $1 and spend $2.48 to make that happen, is there a lot of wasteful spending there that could be cut back? So is it a spending problem, not necessarily a revenue problem? You don't necessarily have to increase taxes, you just have to decrease spending. And if you decrease spending and drive those bond yields down and more people invest in treasuries, you're going to create more private sector work. As I mentioned, when low interest rates happen, people buy more homes, people invest more, people want to spend more because interest rates are low. The private sector jobs, construction companies build more. A lot of good things happen with low interest rates on the private sector side. November 7th, of course, the Fed meets, Bank of Canada. Well, we already met on October 23rd. This is old. December 11th. December 18th would be the next Fed announcement. You see, when rates do fall, they fall quickly. We certainly hope that this trajectory here in the 90s, then you had of course, the dot-com bubble. Rates plummeted very quickly. Then you had the financial crisis when rates plummeted quickly. Then the pandemic, they plummeted quickly, and so on. And now they've come down slightly to begin with, but we certainly hope that trajectory is continuing down. And that's it for me. Thank you.
Bruno, thank you
Unless
so
there's any
much.
questions.
I mean, that was awesome. I mean, I love that we did this today. I mean, that is such, I learned so much that I think that hopefully everybody on the call got a lot out of this, and especially to understand and to educate our clients better, right? Because when the Fed meets, it doesn't mean anything. It doesn't, not for our industry. We've got to be looking at all of this other stuff. And so there's a lot for us to pay attention on as it relates to what's going on out there in the world, which is why I wake up at 4 a.m. every single day and turn on the news and just pay attention and read and read and read and read, so that I have at least some of the answers, when clients ask and so forth. So this was awesome. Was there any questions in the chat? I don't think we had anything, but let's see. We'll get the slides circulated. We'll put them on the growglobal.com website for everybody. We'll do that. And again, thank you so much for being here today, Bruno. We greatly appreciate you all. Don't forget,
Thank you.
tomorrow's the day that we vote. Get out and vote. It's important for our industry, that is for certain, right? Kim, did you have something?
Man, it's like kind of like, I wouldn't say way over my head, but almost way over my head, but I loved it so much.
Sorry. The presentation's
I love
available.
it.
Tracy has it.
I love
And
it.
please, she will
Crazy
share it. If
good.
you have any questions, feel free to email Tracy or email me. I can answer any questions if you have any down the road.
We
But certainly,
appreciate you.
hopefully, your election results in some fiscal responsibility down the road, so we can all go back to 2019 and
Well,
when the
I
rates
love
were very low and the market was good.
I love how you ended this presentation because I've always wondered that, and we're not going to solve it on this call, but I've always wondered, okay, if there's $1 and they're spending $2.49, I mean, come on, let's have common sense, people, right? I mean, I'm a developer and I'm a builder. I'm not going to go out and build a $4 million home and sell it for $2 million. Why the hell does our government do that? It drives me nuts.
And it causes higher interest rates, which is a problem.
It causes higher interest rates because they're not managing it like a business. You know, it does say something. I tell my kids this, you know, you're bad with my money because it's not yours, right? When it's your money, you manage it a lot.
That's a great analogy. I love it.
Good one.
Very good analogy.
You're
Very
bad
good
with my
analogy.
money because it's not
I'm going
yours.
to use that analogy. I'm going to steal it.
Yeah, but it's
like
so
it, but
true
it's so
because,
true.
you know, that's the thing. When you've got a group of people managing our money and they're spending $2.49 to our dollar. Think about that, you all. You can't build a $4 million home and sell it for $2. It just is common sense. So all right, we're not going to turn it into that. Bruno, thank you so much for coming
Thank
here
you.
today. For
I
everybody,
appreciate it.
Bruno is in Canada. This is why we did this. We didn't want this political. We wanted to learn about the economy. We wanted all of us to gain knowledge as it relates to the economy. We wanted to understand, you know, I get asked so often, why haven't the rates lowered? The Fed met, he lowered rates. What the heck? Da 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 da. So who better to explain it than Bruno from Canada and all that great stuff. So we'll get the slides circulated. Get out and vote if you haven't already. I know I'll be wide awake tomorrow night until this president gets announced. So if anybody wants to talk, I'll be up.
Thank you.
Bye,
Politics
everybody.
with Stephanie Gillison.
Do what?
Talking politics with Stephanie Gillison. Hey,
Talking
next
politics.
week. Next week,
Next
let's
week.
not forget about next week. Next week, we're doing our first stories in real estate. Steph,
Oh my gosh, you all, next week, we are telling our stories in real estate because look, stories tell and that's how we learn. And so next week, come. If you've got a story in real estate to share, not one that's going to make everybody laugh and roll out of their chair. I'm talking about a story that we're going to learn from. That's what next week is about. So come with your stories. We're all going to contribute. I've got a story to tell each and every one of you, and it has to do with the feds. So if you didn't hear enough about the feds today, I'm going to tell you some about next week. So, all right.
Yeah.
Till then.
What transaction taught you the most? Everybody learns.
What transaction taught you the
did
most?
you learn the most from that you could share from everybody? And you're going to hear other people's stories of what they learned. So bring a story. We're going to try and fit in as many as we can.
Perfect. All right.
Have a
Thank
great
you,
day.
everyone. Till
Okay.
next time. Thank you,
Bye.
Bruno.
Bye.